to the Principles of Marketing class, Unit 4. We are looking at methods for setting prices, and that's Session 5, Unit 4. By the end of this session, you should be able to give a general overview of how businesses set prices, distinguish between cost plus pricing and markup pricing, discuss break-even analysis. So we are going to look at the general overview of how business sets prices. We will look at the cost plus pricing and the markup pricing first. Markup on selling price and markup on cost. This is the general pricing model, how everyone sets his or her price as a marketer. Many marketers, especially retailers and wholesalers, rely on a comparatively basic method of determining their resale prices. The cost of the production is noted, the cost of the product is noted, and a simple percentage markup is added to reach the selling price. So it is the cost of the product or cost of production plus a simple markup, which gives the selling price. When a markup is expressed as a percentage of the selling price, it is called markup on selling price. For example, a cost of 1 cedi and a selling price of 1 cedi is 50 pesos. A cost of 1 cedi and a selling price of 1 cedi 50 pesos mean a markup on selling price of 33%. The 50% markup is the 33.3% or 1/3 of the selling price. We will work out these for you to understand deeper. When only the term markup is used, it means or it refers to markup on selling price. So when you see any markup, it means that there has been an additional amount on the selling price. However, in many industries, pricing focuses on cost. So the term markup on cost is in common use as well. So when we say markup on selling price, it means that there's an additional amount on the selling price. If we say markup on cost, it means that it is the cost element plus profit element which gives us the selling price. Now, let us work out for this. It says that when a markup is expressed as a percentage of the selling price, it is called a markup on selling price. For example, an item costs 1 cedi and a selling price of 1.50 or 1 cedi 50 pesos mean that there's a markup on selling price. Here, you realize that the selling price is actually 1 cedi 50 pesos. The selling price is 1 cedi 50 pesos. Forgive me for my writing. Okay, the selling price is 1 cedi 50 pesos. The question again said that the cost price is 1 cedi. The cost price is 1 cedi. We are looking at the percentage of the markup which is expressed on the selling price. The cost price is 1 cedi. So now, for us to know the percentage on this selling price, there is a need for us to first of all know how much is the profit on this selling price. To get the profit, it is the selling price minus the cost price, which would give you the profit element. So from this formula, you realize that our selling price is 1.50 and our cost price is 1 cedi, meaning that our selling price of 1.50 pesos minus 1 cedi gives us 0.50 pesos. If 1 cedi 50 pesos happens to be the selling price, then we say that 100% of the cost represents what is on the market. We want to see the additional amount that has been added to it. So 100% of the cost, which represents the selling price, is 1 cedi 50 pesos. 1 cedi 50 pesos. And the profit element is, we want to know the percentage of the markup, and the profit element is 50 pesos. So will the percentage be less or more? It will be less. If less, more divide. So 50 pesos or 0.50 over 1.50 multiplied by 100% gives us, so we can quickly calculate for that, 0.50 divided by 1.550 times 100% or multiplied by 100% gives us 33.333%. is a recurring figure. 33.333%. Good. 33.33%. This should tell you that there is a markup of 33.33% on this amount. That is the reason why we are pricing the 1.50 pesos as the selling price, meaning that there is a markup of 50 pesos on this amount, and that signifies the 33.33%. So in exam, when you are given this question and they ask you that what is the percentage of the markup on the selling price, this is how you go about it. Let us try our hands on another one. An item costs a retailer 50 cedis, and the retailer sells it for 100 cedis. The item costs a retailer 50 cedis, and the retailer sells it for 100 cedis. Sorry. Using a markup on selling price, calculate the markup on cost and the markup on the selling price. The first one we did was on the selling price, and we are going to look at on cost. Calculate the markup on cost and the markup on the selling price for the product. So the first one has to do with the markup on selling price. Markup on selling price. So we try to look for the profit element just as we did. It is the selling price minus the cost price, which is 100 minus 50, which gives us a profit element of what? 50. The question says that the item costs this amount, and the retailer sells it at this amount, and we are looking at markup on selling price, not markup on cost. So we are going to equate this 100, which is the selling price. We are going to equate this 100, which is the selling price, to our 100% as our whole figure. Then we will also look out for the profit margin, which is 50 cedis, equal to what is the percentage? We don't know. We are looking at markup on selling price, so we don't know the percentage on the selling prices. If less, more divide. Since 100 cedis is bigger than 50 cedis, it is definitely going to be a lesser percentage. Therefore, it is going to be 50 over 100, 50 over 100 multiplied by the 100%, multiplied by the 100%, which gives us 50%. So the markup on the selling price is actually 50%. The markup on the selling price is actually 50%. Now, let us look at the markup on cost. What percentage has been added to the cost price to arrive at the selling price? What has been added to the cost price? First of all, we looked at what has been added to the selling price. Now you're looking at what has been added to the cost price. Markup on cost price. We all know that the cost price was 50 cedis, and the profit element we realized was the formula for finding the profit element is selling price minus cost price, and what we extracted was selling price was 100 cedis and the cost price was 50 cedis, meaning that the profit element was 50. Therefore, there is a profit element of 50 and a cost price of what? 50. If 50 is equal to 100%, if 50 is equal to 100%, then what will be the percentage of this same 50? I hope it is clear. So since 50 is 100%, the profit element 2 will give us the same percentage, which is the 100%. So 50 over 50 multiplied by 100 is going to be 100%. We can therefore conclude that the reseller, either wholesaler or retailer, added 100% profit element to get the selling price. As it is very clear here, using a markup based on cost makes it appear that the marketer's markup is higher, meaning that the marketer's markup was 100% versus the 50% profit we had. Cost-based pricing. Cost-based pricing. Manufacturers often use a pricing method similar to markup, in which they determine what costs were involved in producing an item and then add an amount of the cost total to arrive at a profit. What happens is that they determine the costs that they incur during production and they add an additional amount to the cost total so that they can arrive at the price. Just like markups, cost plus method is easy to use once an appropriate addition to the cost has been determined. Just like the markups, cost plus method is very easy to use once an appropriate addition to the cost has been determined. Much of government contracting is done on the cost plus method, with the supplier of the good or service submitting the cost figures associated with a particular project and adding a reasonable profit. The underlying word is reasonable profit, reasonable, not an outrageous profit, reasonable profit margin to yield a total price for the project. So what some service firms do is that they try to get the exact amount of production, then they add a reasonable amount just to arrive at a selling price. This also happens to marketers of goods. The average cost method. The average cost method. Identifying all the costs associated with the manufacturing and marketing of a good or the provision of a service should make it possible to determine what the average cost of a single unit of good or service might be. Let us look at this critically. You realize that assuming all costs, let's say production cost is 80,000 and the number of units produced, average units produced or number of units produced is 100, number of units produced is 100. To get the average cost method, you divide the number of units produced by the cost which was incurred during production. So all costs incurred was 80,000, the number of units produced was 100. So 80,000 here, 80,000 here, divided by the units produced, which was 100, all over 100. These two zeros will be crossed out. Therefore, the average cost of a single unit is 800, So if we use the shito for instance, assume that after producing all the shito, I incur a cost of 80,000 and I come up with 100 bottles. For me to know the cost of each unit produced, I would have to divide the 100 by the 80,000 to get 800. So 800 is the unit cost of every product, the unit cost of every product. To get the average cost method rightly, you would first of all have to look at the average cost of a single unit, that is the 800, then you will use it to proceed further. Now, since all cost is 80,000, a firm can have a reasonable profit element he or she would want to add. Then let's assume that the reasonable profit margin is 20,000, which means that the firm gets an amount of 100,000. To get the price of each product, this 100,000 would be divided by the 100 units produced. This 100 units produced. So in order to be 100,000 all over 100 units produced, which will give us a cost of 1,000 cedis. So with the 1,000 cedis, we can say that it is the selling price of every unit produced. Average cost of a single unit include a profit margin. So this is the price that will be given in the price that will be given on the market as the selling price, because it is the average cost incurred plus the profit element. Target return pricing. Target return pricing. You probably remember from your accounting class that total costs are the sum of fixed and variable costs. So total costs consists of both fixed and variable costs. Fixed costs are costs that do not change in the short run, and they are incurred even when there is no production. Fixed costs are incurred with the passage of time regardless of volume. Variable costs fluctuate with some measure of volume. So with variable costs, it varies according to the number of units you are producing. A marketing manager using target return pricing first calculates for the total fixed cost figure. This figure includes such items as executive salaries, rent, the cost of machines, expenses that must be paid even when no unit was produced. So you talk about depreciation, you talk about the rent, you talk about the bills. Sorry, you talk about the costs that would be incurred, like the rent, the salaries, even when no production happens. And you talk about the royalties, like for the land, because the owner of the land will still charge you a royalty even if you don't produce. A target return, usually represented as a percentage of investment, is added to the total cost to yield a figure representing the total fixed cost and the target return. Let's look at how it's computed. So the fixed cost plus the target return, all divided by the unit to be sold out. So this is not the unit produced, the unit you are taking to the market that will help you get your average target return. But production and sale of each unit involves variable costs as well. Suppose these costs are calculated to be 75 per unit. So suppose that the variable costs are to be calculated 75% per unit. The figure is added to the already determined cost per unit. So with this, you will realize that the fixed asset plus the target return all over the units to be produced becomes 500 all over 1,000. The fixed cost is the 500,000. Let's assume the fixed cost is the 500,000 plus target return, which is the 500,000. All over units to be sold, and we have 1,000 units to be sold. The unit to be sold. This figure is added to the already determined cost per unit. So the 500,000 divided by 1,000 would give us 500 cedis. Will give us 500 cedis. This figure is added to the already determined cost per unit of 500 to indicate that the price per unit should be 575. This 575 actually comprises of the fixed cost plus target return all over unit to be sold plus the variable cost of each unit, which is 75. So therefore you are getting 575. As in the case of the average cost method of pricing, a miscalculation of the demand for the products can be disastrous. So because we are using the unit to be sold and not units sold, if there is any distraction in the number of units which would be demanded, there will be some form of distraction somewhere. If the firm's customers demanded only 500 units of the product, not the expected 1,000, the carefully calculated price of 575 would lead to a loss. What happens to this method is that it calculates using the unit to be sold and not units sold. When marketers raise their expectations and think that he or she will end up selling 1,000, but they buy the actual units sold will be 500, it will be realized that marketers will run at a loss. Also, if it happens that they estimate what they will sell 100 and they go to the market and they realize they are going to sell about 150, you realize that the profit elements would increase in that what customers have requested for is more than what was budgeted. As we all know, all marketers, whether of consumer goods, organizational goods, or services, face costs that must somehow be recovered or recouped. These include fixed costs and variable costs. Fixed costs are the costs that one incurs even when production is done, but variable costs varies as and when production is being made. Variable costs would be zero if no products were produced and marketed, which is very true, but fixed costs would remain at their established level even if production and sales happens to be zero. The summation of fixed costs and variable costs gives one a total cost, which is represented by TC. Total cost increases as production and sales increases. One thing we have to know is that in the short run, fixed cost does not vary, but in the long run, fixed cost varies because there can be boom in sales, and because of that, the firm would have to double up its production, and as a result of that, there will be the need for additional machines, there will be the need for a scale up at the production unit and whatsoever. This should tell you that at a point in time, fixed cost varies. With regard to revenue, the hope is that each additional unit of goods manufactured and sold, or each additional service performed and paid for, will raise the firm's total revenue. Total revenue equals price per unit times units sold. The total revenue has to do with the number of units sold times the price per every unit. Now, let us look at the cost, revenue, and break-even point. Cost, revenue, and break-even point. As this diagram depicts the relationship between the total revenue and the total cost, you realize that when total cost is higher, this is the total cost graph. This is the total cost graph. When total cost is higher than total revenue, there is a loss. That is why we can see the loss area. And when total revenue is higher than total cost, there is a profit. This should tell you that when the number of units sold multiplied by the selling price increases, the costs you have incurred as a producer will be lesser, because the total revenue consists of both the selling price and the profit elements in addition. So anytime that TR, or total revenue, is greater, anytime it is greater than total cost, then it means that the firm has yielded at a profit. And when TC is greater than total revenue, it means that the cost that the marketing firm is incurring is greater than the amount, is greater than the selling price together with the profit elements the firm is charging. But when total revenue and total costs are the same, when TR is equal to total revenue, when TR is equal to total cost, it means there is a break even. At this break even point, the firm doesn't make a loss, neither does it make a profit. The amount you spent in production is the same amount you have recouped in the market. So this is the break even point. When total revenue exceeds total cost, it results in a profit, like I have explained. And at the start of production, so you see 0 units are being produced, total revenue is 0 because no sales are being made. So the total cost curve does not start from 0, but the total revenue curve starts from 0, because if 0 units are produced, 0 total revenue will be achieved. But total cost curve does not start from 0, because even when there is no production, the firm will still incur a fixed cost. Remember, total cost is fixed cost plus variable cost. However, fixed costs such as rent are already been incurred. Therefore, the company is suffering a loss at this point. The point at which cost and revenue meet is called the break-even point. At this point, the money received is the same as or equal to the money going out. In summary, we have learned that businesses use different methods to set prices for their products. The price methods include the cost-based pricing, the markup, target return, and the break-even analysis. This brings us to the end of this lecture. See you in the last session. Thank you.